All right, it's 1 o'clock. Let's go and get started. Good afternoon, everyone. How's everyone doing today? Good, good, hanging in there. Okay, probably the big elephant in the room is, your midterm one scores are graded. So I have the exams with me today. So if you're here in person, you can pick up the exam after class. If you're on Zoom, I'm going to bring the exams again on Thursday. So if you weren't able to make it today, then you can come on Thursday and pick it up, right? So the average for the exam was 36.5 out of 50. So the average percentage is about 73%, which is, about what I expected for this exam. Remember, I think this is a good time to kind of remind you of the policies that we have in this class. So remember, we have two midterm exams that you guys are taking. So we're taking one that you guys just took, and then the second exam is going to be based on the taxes, replacement decisions, inflation. So that's going to be the second midterm. Between the two midterm scores, whichever midterm that you do better in, I'm going to count as a higher percentage of your grade. Remember, so one of your exams is going to count for 30% of your grade. That's whichever one you score higher in, and then the other midterm exams will be 20%. So if you didn't get the score that you wanted for this exam, you can kind of make it up in the next exam. So if you do really well in the next exam, it kind of dwarfs this exam kind of in comparison. And if you did do well on this exam, just know that you kind of have that in your back pocket already. So that's, 30% of your grades already kind of set, and you're kind of good to go from there. So, remember, there's lots of mechanisms for this. And then, we have the final project that's all obviously worth a lot of points on your grades as well. Okay. All right. So you can come pick it up. Yeah, so I honestly I was kind of rushing to finish them up. So if you guys were up late last night, I put the grades in at like 10:30 last night. So I might have made some mistakes, just either adding up the points or or just kind of giving you credit for the exam. So once you do get it back, please look it over. If I made any mistakes in terms of adding points up, or if you think you deserve more points on a particular problem, let me know. I make mistakes all the time, and so I'm always happy to look at things a second time. Okay, I think now is also a good time to kind of take a step back and just kind of talk about the rest of the semester. So we're kind of right at the midway point here. So for the class so far, so for the first 7 weeks, we've mostly just been focusing on economics. We've been talking about interest rate, taxes, things like that. We have about 2 or 3 more weeks, 2.5, 3 weeks of economics left, and then the rest of the course is going to be on engineering ethics. And so talking about just, what's the ethical side of being an engineer, what are some considerations that you have to make, and how that kind of interplays with kind of the economics, because oftentimes these two are at odds. And so I'll give you guys a little preview right now. So, we'll of course talk about this in a lot more detail in a couple of weeks, but your final project in this class is going to be an ethical case study. And so I'm going to have you guys look at a historical ethical situation in engineering. For the most part, these are all bad things that happened. And so I want you guys to analyze kind of what went wrong and kind of what were some of the conflict of interests, and some of the safety concerns and risk concerns that was there. So, we'll talk about that. And so the only reason I bring it up now is because there's been a lot of news on it lately. And so Boeing is in some deep shit right now. I'll say that. So it's definitely something to kind of look for in the news. So there's a lot going on, especially in terms of like data privacy. So, there's a whole TikTok thing going on right now too. So, if you haven't really been paying attention to the news, definitely now is a good time, because there's a lot of ethical case studies that are kind of unfolding in real time in front of us. So definitely start, pay attention to those and start thinking about that for your project. Okay. All right, so the plan for today is we're going to finish up our lecture notes on taxes. So I have about 3 more examples that I want to do for you guys. We have two more depreciation schemes to go over, and 1 example to kind of wrap everything up together. And then we're going to move on to our next topic, which is called replacement decisions. And so we'll talk about kind of what that means and kind of define these 2 terms, economic life and useful. Okay. All right. Are there any questions I can answer about the exam or just anything before we get started for today? Okay. All right. So let's go and get started. All right. So remember, the unit that we're on is taxes and depreciation. All right. So this is a big unit, and so we've been talking about this. I think this is the 4th lecture that we spent talking about taxes and depreciation. And this will be the last one. And so the idea is that when you're a business, or when you're operating a business in the United States, or in any country really, the government is going to take a slice of whatever profits that you earn. Okay, so those are called income taxes. Okay. Whether that be as an individual or as a business, right? Whatever money that you earn and changes hands, basically, the government's going to tax you on. Okay, but there are ways for companies and for individuals to reduce their tax burden, or to kind of reduce their taxable income. Okay. Remember, we defined this term before, taxable income. That's the That's the amount of your income or the amount of money that you make that's actually subject to taxes. Because not every dollar that you earn is going to be taxed by the government. Right? Because what people usually do is that any expenses that they incur to run their business, they can deduct that away from their taxable income. Okay. So we didn't talk about this too. We didn't really talk much about the motivation behind this, but part of the motivation for having this kind of system is to encourage businesses to kind of invest the money that they earn into growing their business, which in turn grows the economy, which is kind of good for everyone in the country, right? And so by having this mechanism of whatever money that you spend to actually run your business, materials that you buy, and labor that you purchase, machines that you buy. If that can lower your tax burden, that's kind of what incentivizes companies to kind of take the money that they earn and kind of put it back into the economy. That's the idea. Okay. In particular, we're focusing on the idea of depreciation. Okay. So depreciation refers to deducting away or expensing away your large capital purchases. Which is a very, very common occurrence for engineering companies or engineering firms, because to perform engineering work, for the most part, especially mechanical engineering, you're going to be purchasing large pieces of equipment, large amounts of material, right? Large things that that last more than 1 year, right? So the basic idea is that when you make a large purchase like this, that large purchase is going to retain value over many years. But each year, that large purchase is going to lose a certain amount of value. So if you're gonna sell your car, a year after you bought it, you can still recoup a certain amount of value that you bought it for, but there's going to be a certain loss that you're going to incur. Okay. And so the idea with depreciation is that the amount, the amount of value that your assets lose per year for your large purchases, that you can deduct that from your taxes. Okay. Okay. That's the idea. That's the idea anyway, right? So far, we've gone over two different schemes for depreciations. We've gone over straight line depreciation, which is the most straightforward, as well as declining balance depreciation, which is a little bit more advanced. Okay. The third scheme that we're going to go over kind of actually breaks all of these rules, and so the only reason I'm kind of reviewing this again right now is because that what we're about to talk about kind of doesn't really follow this at all, but it's becoming a very important tool for tax accountants in businesses, especially with the recent administrations kind of encouraging this from businesses, and so this is kind of an important one to know for I guess today's economy. But that's the general idea, right? And so if you're working in project management for your company, reducing your tax burden is going to be is always going to be a really big part of what you do. So this is a very important opportunity. All right, any questions on this so far? Okay, All right, so let's get into the next depreciation scheme. So this is scheme number 3. Okay, this is called bonus depreciation. All right. So normally with depreciation, the whole concept of depreciation is that you kind of slowly depreciate the value of your asset over time, right? Um, Bonus depreciation, on the other hand, lets you expense a certain percentage of your asset's costs immediately upfront. And so as opposed to letting this happen kind of slowly over time, with like a straight line method or a declining balance method, with bonus depreciation, you immediately get to depreciate. Okay. The name is a little bit of a misnomer, and so I think when people see bonus depreciation, it's like, oh, I can kind of double dip. But once you depreciate, or once you kind of apply bonus depreciation, you only, you'll usually have a certain amount of book value left. Okay, so once you apply bonus depreciation, that amount's already been depreciated, so you can't get that back. Okay. Okay. All right, so I'm going to do a very quick example just to illustrate this to you, because I think last time I taught this was a little bit of a point of confusion. So let's say that we have an asset worth $10,000. Okay. And we're going to subject this to 60% bonus depreciation. Okay. So that means, right, 60% bonus depreciation means that right away, kind of right from the beginning, or year one, we can depreciate 60% of this asset's value. So if we start with 10,000, okay, 60% of 10,000 is 6,000. Okay. And so this $6,000, we can depreciate that from our first year's expenses. Okay. So it's an immediate deduction. So you take, whatever 60% of your 10,000 and you deduct that away. Okay. But, you know, we didn't depreciate all of it. And so what we have left is 4,000. Right. So that's the amount that we didn't depreciate away. This $4,000 now becomes the book value for our asset. Okay. In other words, what this means is that, according to tax purposes, this asset is now worth $4,000. Okay. So the rest of that $4,000, likely we're going to use another depreciation scheme to depreciate this remaining amount. So that's the last example we're going to do today. So in the last example, we're going to combine different depreciation schemes. But what I wanted to kind of illustrate with this very quick example is that once you apply bonus depreciation, that value is gone, right? Because I think what some people have done before, and I've seen this where people have kind of double dipped on the depreciation. So let's say I give you a problem and I say that you have 60% bonus depreciation. So in year one, they deduct away $6,000 of expenses, which is correct. But then what they say is that, for the rest of it, the value of the asset is still $10,000. And so you kind of, and then they depreciate that $10,000 over the rest of the life of the asset. Okay. So you can't double dip, right? So you can't double dip. At the end of the day, by the end of the asset's life cycle, you're going to depreciate all of it, but you can never depreciate more than the initial cost of the asset. Okay. So I just want to make that clear. So even though it's called bonus depreciation, it's not actually a bonus. You're just taking a slice off the top kind of immediately. Okay. All right. Any questions on that? Okay, so let's put it all in an example. So this is the real example. That was kind of the quick example. Okay. All right, so let's consider the same example that we did last Thursday, except we're going to use bonus depreciation. So I think the context for this example is that we bought a new truck. We're a delivery company, and that this truck is expected to produce $20,000 of revenue per year and has an initial cost of $50,000. Okay. So the difference here, in terms of the tax calculations that we're going to do, is that we're going to subject this to 100% bonus depreciation. Okay. So we're going to deduct the entire cost of the truck in the first year, and we're going to see what that does to our expenses here. Okay. All right. So just like before, let's go ahead and make our table here. So for tax calculations, remember we have to make this table. We have one column for the time period. We have another column for the before tax cash flow, so that's going to include our revenue as well as our initial cost. We have another column for depreciation. We have another column for taxable income. Another column for the taxes. Another column for the after-tax cash flow. So after we subtract taxes from our revenue, that's what that column's going to look like. And even though it's a little bit trivial in this case, we'll have another column for the book value. Okay. So the book value, remember, is the remaining value or just whatever the current value of the asset is at that particular time. Okay. All right, so this particular asset we know is going to last 5 years, and so let's do this analysis for 5 years. Okay. All right, so at time period 0, so remember this is the present day. Let's say that we bought the truck, and so our before tax cash flow is $50,000. Okay. We didn't depreciate anything just because this is literally the moment that we buy it. So it hasn't lost any value yet. We hasn't made any money yet, so it's all going to be nil there. Okay. For the after-tax cash flow, it's still going to be the same as our before-tax cash flow. This is just the purchase price. Okay. Right. And then at that exact moment, the moment we receive the keys to the truck, the truck is worth $50,000 because that's the check that we just handed over to the dealership, right? So, right at that moment, everything is worth that amount. Okay. Let's fast forward a year. So we're at the end of year 1. So we've used the truck for a year. Okay. Right. During that time, that truck produced $20,000 of revenue, just like this, like we said. Okay. So our before tax cash flow is plus 20,000. All right. Now we come to the depreciation column for the first year. Right. So if we're using 100% bonus depreciation, that means that in that first year, for tax purposes, our truck is going to lose 100% of its value, right? And so we're going to be able to depreciate all $50,000 of its value. So the depreciation in that first year is going to be 50,000. Right? So this right here is a direct consequence of the 100% bonus depreciation. Okay. All right, remember, usually it's not like this, right? So usually we just have a smaller number here because that truck only lost a certain amount of value, during that year. Okay. Okay. Next, we can compute our taxable income. So remember, our taxable income, we can take our before tax cash flow and subtract the depreciation. And so in this case, our taxable income is actually going to be negative. Okay. So we only made $20,000, but according to the bonus depreciation, we deducted $50,000 away from that, and so we get a negative 30,000 here. Okay. And so if we multiply that minus 30,000 by the tax rate, which is 21%, then we get a minus 6,300. Okay. And what does negative taxes mean? So normally, if your taxes are positive, that's money that you owe the government. But if your taxes are negative, that's a tax return. That's money that the government is going to give back to you. Okay. So negative tax. Okay. So all that means is that you're just getting money back from the government. Okay. Which is pretty common, actually. So if you're a typical salary employee, there's a standard amount of deductions that you can claim as an individual. And so for a lot of people, actually, when you file your taxes, which now that I'm thinking about it, it's coming up soon. I need to get on top of that. You should get some money back from the government just because of those standard deductions. So for businesses, it's less common, but there are situations like this where if you take 100% bonus depreciation, you can get some tax returns. Money back from the government. Okay. Okay. And so if we compute our after-tax cash flow, it's actually going to be an increase in this case. And so, for this particular situation, we made $20,000 in revenue. We're also getting $6,300 back from the government. And so our after-tax cash flow is going to be a positive 26,300. Okay. So that's our revenue plus our tax return or tax credit. Okay. All right. And then we come to the book value. And so, we've depreciated 100% of the value. So we basically treated that truck as kind of like an ordinary necessary expense. And so according to the tax books, our truck has zero value because we've depreciated it all away. Okay. So our book value is zero. All right. Any questions on that row there? There's kind of a lot going on there. Oops. Okay. All right. And so from here, the rest of the table is pretty straightforward because we don't have anything more to depreciate anymore. Okay. All right. So in year two, we're going to make $20,000. We don't have anything left to depreciate, and so our depreciation is going to be zero. And so our taxable income here is a positive 20,000. Okay. The taxes that we're going to pay is 4,200. And so our after-tax cash flow is the 20,000 minus the 4,200, which is 15,800. Our truck still has zero book value. Years 3 and 4 are going to be exactly the same, so I'm just going to write those in. All right, and then year 5. So remember, so this is a detail from last week. But remember, one thing that we always do, since we're done using the truck after 5 years, we're going to sell it for $10,000. And so not only do we earn the $20,000 of revenue for that year, we're going to get an additional $10,000 from this. Okay, so this 30,000 here is from $20,000 revenue plus $10,000 salvage value. Okay. So we sell the truck to someone else. We go on Craigslist and sell it for 10K. Okay. All right. We still have zero depreciation because we've already depreciated it all away. And so our taxable income in that last year is a full 30,000. Okay. So that means we're going to pay increased taxes that year as well. And so our tax that we're going to pay that year is 6,300. And so our after-tax cash flow is 23,700 with zero book value. Okay. So actually, I at the end of class on Thursday, we talked about kind of ordinary gains and in this case, we sold the truck for a higher value than its book value, right? We sold the truck for $10,000, but its book value was zero. So I think I misspoke last week, and so I think I mentioned that you would have to apply additional tax on top of what we're doing here. That's actually false, and so we've actually already incorporated that tax because this extra $10,000, right? We already are taxed on it right here. Okay. So you can see kind of an example of, if you were to salvage something at a value that's higher than its book value, you're paying taxes on it just because there's nothing left to depreciate at that point. Okay. So that tax is already included there. This does not account for capital gains tax. But that's kind of a whole separate category. So that's a can of worms I don't want to open. So this is a ordinary gains tax, right? So you're selling something for less than its initial cost, but higher than its current book value. Okay? And so ordinary gains get taxed at the normal rate. Okay? Yeah. So I apologize for the confusion. I think I kind of said something a little bit misleading last Thursday. Okay. All right, and so that is our tax table there. So now at this point, we can take all of the cash flows in the last column here, okay? And we can compute the after-tax present worth. All right, so the after-tax present worth, we have a minus 50,000. That is our initial cost. Okay. Plus, we have the the tax credit that we got in the first year, so that's 26,300. Okay. That is a future sum, so P over F. Or I forgot to give you the interest rate. The interest rate here is 10%. Okay. 10% and 1. Okay. We have all the revenues from years 2, 3, 4, and 5. Okay. So it's 15,800. Okay. So we need to multiply this by factors in year 2, 3, 4. Okay. So this is P over F, 10%, and 2 plus P over F, 10%, 3 plus P over F, 10%, and 4. Okay. So that takes care of revenues in years 2, 3, and 4. And then we have our revenue in year 5. So that's a plus 23,700 multiplied by P over F, 10%, and 5. Okay. We probably could have done something with uniform series in this case, but for the most part, a lot of tax calculations end up like this. We have to treat each year as kind of an individual future sum and then convert each of them individually with a P over F value. Okay. All right, so if we run through this calculation here, we plug in all of those conversion factors. What we get is $24,348.46. Any questions on how we got that number or just anything about this example here? Okay. So if you look back on your notes, if you look back at the previous two examples that we did with straight line depreciation and declining balance depreciation, what you'll see is that this is the highest present worth that we have so far. Okay. So ideally, the most ideal thing you can do from a tax perspective for depreciation is 100% bonus depreciation, right? That gives you the most money on hand in the present than compared to all the other cases, right? I think we talked about this near the end of class last time, that a more preferable depreciation scheme is one that's more aggressive, that depreciates things more heavily up front, okay? And 100% bonus depreciation is kind of the most extreme case of that. All right, I think over COVID, I think kind of the tax policy in the US was 100% bonus depreciation, just because we were going through that kind of crazy time and the government was kind of encouraging businesses to kind of stay afloat. And so they did 100% bonus depreciation. I don't know if they're still doing it right now, but this was the policy for a while. Okay, so that's scheme number 3. So the last depreciation scheme that we'll go over is something called the Modified Accelerated Cost Recovery System. So it's kind of a mouthful. And so usually we abbreviate this, and so this is usually abbreviated as MACRS. Or MACRS, as I like to call it sometimes. Okay. All right. So the modified accelerated cost recovery system, this is another depreciation scheme that was, it's been a relatively recent development, relative to the entire history of the United States. So this system here was introduced in the Tax Reform Act of 1986. Okay. And the purpose was to kind of streamline, tax calculations. Although ironically, compared to all the schemes we're going to talk about, this is going to take the longest to explain. So, not really streamlined in terms of simplicity, but streamlined in terms of calculations. That's the idea. Okay. So the idea behind this is that, I think this was introduced in a time when kind of there was a lot of uncertainty. There was a lot of there's a big boom of technology being developed, and determining depreciation schedules or how quickly an asset loses value was kind of uneven, and it was kind of unevenly applied to different sectors of the economy. And so the idea behind this is to kind of say, all right, if you have an asset that can be depreciated, we first need to classify what type of asset it is. And so the first thing you're going to do with MACRS is to take your asset and find out which category it belongs to. And then depending on the category that it belongs to, that's going to set its depreciation schedule. Okay. So let's go over the different types of classifications there are. All right. And so this list, I have to admit, this list here is a little bit old, right? So the way that these are classified is not super up to date. But and probably the real list that the IRS uses is a bit different than this. It's more nuanced, but this is kind of a more simplified list to kind of give the idea of how this system works. Okay. Okay. So the different categories that we have here is basically determined on how long this type of asset lasts in general. Okay. So we have things like a 3-year property, 3-year asset. Okay. We have a 5-year asset. We have a 7-year asset. And I'll go one more. All right, so I'm not going to write the whole table on here just because that would take, that would probably take the rest of class. But basically, under each type of asset here, you have a different type of property. Okay. And so the second column here in the table is going to be a description of what goes into that category. Okay. All right. So for example, for a 3-year property or 3-year asset, we have things like food and beverage handling devices. Things in plastic manufacturing. Okay. So plastic products that are used for for daily life, and as well as fabricated metal products. those are some examples. There's more, of course, in this category, but those are just a few examples, right? Generally, these are devices that are only expected to last about 3 years. All right, in the 5-year category, we have things like automobiles and trucks. Aircrafts, research equipment, and computers. Okay. So if your company purchased one of those types of assets, those will fall into a 5-year category. Okay. These more or less are kind of accurate. For the most part, I can tell you, I know a lot about the computer realm just because that's kind of what I do a lot of my research in. And usually, you're going to replace your computers, you're going to replace your high performance computing clusters, supercomputers about every 5 years. And so that sounds about right. Okay. All right, 7 years. And so here we're getting to a little bit more permanent stuff. So these are things like office furniture, fixtures, and the all-important other category. So things that don't really fall into any of these other categories, we usually are classified as a 7-year asset. Okay. So office furniture seems kind of silly, and at first I honestly thought that office furniture was kind of silly as well. But some office furniture can be really expensive. I went to I was at a mall recently with my wife, and we went to it's like a Herman Miller store or something like that. They're selling office chairs there for like $2,500. It's crazy. Then apparently Disney buys those furnitures for all their employees, and so they can expense it away, from their tax. And so yeah, part of the tax dance that they do, I guess. Okay, and then a few examples for 10-year properties. And so these are kind of a lot more heavy duty stuff. So this is petroleum refinery, um, and water transfer equipment. Okay. So again, these are just kind of a small list, but I think we've hit kind of the more important ones that have to do with engineering. Okay. So the first step in using MACRS is determining, which category that we're in, whether 3-year, 5-year, 7-year, 10-year, they even go up to 15 and 20 years as well. Okay. And so the idea is that once you've chosen a category, then you can use the next table to determine the depreciation schedule. Okay. All right. So the way this table works, we're gonna have one column for the year. Okay. So this table is going to describe, how much you should depreciate each year for those certain types of assets. Okay. So we'll call for a 3-year asset, 5-year asset, and I'll do a 7-year. But of course, there's different columns for like a 10-year, 15-year, 20-year asset as well. But then it just kind of becomes busy work. Okay. Okay. All right. So what you're going to see in these tables is that each entry in the table is going to be a percentage. Okay. For example, so if we go down the list for a 3-year property, you're going to see certain numbers like this. Okay. So the first entry in the table for a 3-year property is 33.33. So that's about 1/3. Okay. That tells us that if our asset is classified as a 3-year property, then we're going to depreciate 1/3 of its value in the first year. Okay. So each column. So each entry there tells you how much percentage of the value is going to be lost or depreciated. But it's important to know that you're multiplying this percentage by its initial cost. Okay, this is a little bit different than declining balance. And so if you remember from declining balance, we multiply that percentage by the remaining book value. And so the idea with MACRS is to kind of simplify that, so you're not keeping track of book value anymore. You're multiplying just by the initial cost. Okay. So the idea is that if you add up all the percentages in a given column, it should equal 100%. Okay. All right. So one other thing that I'll highlight here is that, if you'll notice, for a 3-year asset, we actually have some percentage in the 4th year, right? And so what this table is implying is that the asset is going to retain value after the 3rd year. Okay. So this is pretty normal. And you're going to see that for all of the columns here, that you're going to have percentage, you're going to have depreciation 1 year past its classification. Okay. And the reason for that is that MACRS adopts what's called the half year assumption. Okay. Okay. So what that means basically is that MACRS assumes that whatever asset you buy actually gets put into action in the middle of the first year. Okay. So that means that asset were to last a full 3 years. That means after the 3rd year, you still have like half a year's left of the asset left. Okay. So because MACRS assumes that it doesn't start till the middle of year 1, and you're going to have like a half a year's of depreciation at the end. Okay. So that's all that means. So we're going to see that for the 5-year and the 7-year asset as well. Okay, so let me go ahead and fill in the rest of the columns here. So for a 5-year asset, we start with 20%, then 32%, then 19.2, 11.52, 11.52, and then 5.76%. Okay. So again, even though it's a 5-year asset, we leak a little bit into the 6-year. That's okay. Okay. And then for the 7-year asset, we have 14.29, 24.49, 17.49, okay, so those are the numbers for the 7-year asset. Okay, so I have these full tables in the lecture notes that are posted online, so you don't have to kind of scramble to write these down, but we're gonna use it in the next example. So just I wanted to have it here for reference. Okay. All right. Any questions on this? All right. So MACRS takes a while to explain, but once you get it, then it's basically just using this table right here. So you're going to classify. Then once you classified it, you just take the percentage and multiply that by the initial cost. Okay. Okay. So let's do another example. I call it another example, but it's the same example that we've been doing. So for the fourth and final time, we're going to be buying a truck. Okay. Right, I'm not going to write out all the stats again. It's the same as before. The truck costs $50,000. It's going to generate $20,000 of revenue each year. We're going to sell it for $10,000 at the end. Okay, and we want to find out its after-tax present worth. Okay, but this time, instead of using our previous depreciation schemes, we're going to use MACRS. Okay. We're going to use MACRS to perform the depreciation, and we're going to classify it as a 5-year asset. Okay. All right, so let's get started on that. Okay, so let's go ahead and make our table. So when you're using MACRS, you don't need to keep track of the book value. And so I'm just going to leave that column. Because remember, all the percentages that we had in the table above are based solely on the initial cost. Okay. Okay, so we're going to use this truck for 5 years. So let's make 5 rows, or I guess 6 rows, including row 0. Okay. All right, so in year 0, same as before. Year 0, we're going to purchase the truck, and so that's going to be a minus 50,000, both for the before tax and after tax. So we already paid taxes on that, so we don't need to account for it again. Okay. Our income each year, just because these are the same as before. I'm just going to write down all the before tax cash flows. So we're going to have $20,000 in years 1 through 4. Okay. Year 5, we're going to sell the truck, and so we're going to sell the truck for $30,000. Or excuse me, we're going to sell the truck for $10,000 on top of the $20,000 of revenue that we had. Okay. All right. So now we come to the depreciation column. Okay. Remember, we're going to use MACRS. All right, so we're going to use the percentages from the table, and we're going to multiply them by the initial cost, which is 50,000. Okay. So the nice thing about using MACRS compared to some of the other schemes is that you can compute the full depreciation schedule right from the get-go, right? Because it's all just based on two things. It's based on the initial cost and it's based on the percentages in the table. So first thing I'm going to do is I'm going to write down all the percentages from the table. Right? So if you look up at a 5-year asset here, right? We're going to start with 20%, then 32%, then 19.2, then 11.52, 11.52, and then 5.6. Okay, so that means in year one, we're going to multiply by 20%, which is 0.2. Year two, we're going to multiply by 0.32. Year three is going to be 0.192. Year four is going to be 0.1152. Okay. The fifth year is going to be interesting because technically there is a sixth row in the table, right? But we're only using this up to 5 years. And so for the fifth row here, we're going to take the entry in the fifth row, 0.1152, plus we're going to add in that last percentage. And so, whatever was left at the end of year 5, we depreciate that normally in year 6. But since we're not going to year 6, we're going to depreciate the rest of this here. And so it's going to be plus 0.0576. Okay. This one in particular is a combo of year 5 and 6. All right, so those are the percentages in the table. We're going to multiply these all by 50,000 because that was the initial cost or the cost basis. Sometimes you'll hear it called that. So that's going to give you the depreciation charge or the depreciation amount for that year. Okay. So for year one, we have 0.2 times 50,000, which is 10,000. Okay. Next year, we have 32% of that, which is $16,000. Okay. Then 9,600. Then 5,760. Okay. And then the last year, we have 5,760 plus the 5.76%, which is 2,880. Okay. Let me move this divider here just so it's a little bit easier to see. Okay. All right, so everything I'm underlining, that's the actual depreciation amount for that year. Okay. All right, so from there, it's pretty standard. So we're going to take our depreciation and subtract that from our before tax cash flow. So our taxable income for the first year is 20,000 minus 10,000. So we're only getting taxed on $10,000 of that. And so the taxes we're going to pay is 2,100. And our after-tax cash flow is 17,900. Okay. Year two, our depreciation is 16,000. And so if we subtract that from our revenue of 20,000, that means our taxable income that year is $4,000. Okay. We multiply that by taxes, and so we only paid $840 in taxes that year. Okay. And so our after-tax cash flow is 19,160. Okay. All right, rest of the table, just for the interest of time, I'm just going to fill in very quickly. All right, question. Can I explain the multiplication for year 5 and depreciation again? Why are year 5 and 6 combined? Yeah, good question. So normally for a 5-year asset under MACRS, you extend the life of the asset until the 6th year, right? And so this 5.5 or this 5.76%, that's how much you would depreciate in that 6th year. So that would be this one right here, right? But this problem tells us that we're only planning on using the truck for 5 years anyway, right? And so whatever depreciation that you have left, basically when you sell the asset, you basically just whatever is remaining on your book value, you just depreciate the rest of it. So at the end of that 5th year, we still had 5.76% of the initial value. And so that's why I just lumped that together into the last year. Yeah. So the depreciation you get in year 5 is year 5 and 6 combined, because we're not actually using it for the 6th year. And then this last year, 21,360. Taxes that we pay is 4,485.60. And our after-tax cash flow is 2,554. All right, so it does, so it's always a trade-off, right? So using MACRS, computing the depreciation is simpler, right? And so you just multiply the percentages by the table. But because the percentages are often different every year, it makes your after-tax cash flows pretty irregular. And so, all right, and so if we were to compute the after-tax present worth, we'd have to go through this entire column right here, which is not fun, but you can do it. Okay. All right. And so if we did the same thing in the example that we did before, so we treat each one of these as kind of an individual future sum. Okay. So we compute the after-tax present worth. Okay. Just in the interest of time, I'm just going to skip that. Remember, the interest rate here is 10%. Okay. So the after-tax present worth that we get is $22,951.32. Okay. That's what you get for taking the present worth of that last one. Okay. Yes. All right. Any questions? Any questions on this example here? All right. So tax stuff. I think it's not the most difficult thing in the world. It's probably the most tedious thing that we're going to do in this class. So making these tables, honestly, it's kind of hard to get away from it. It's very hard to do these calculations without kind of accounting for every single step. Especially when you have a situation like this where your taxes are going to be different every single year. And so the only way to kind of stay organized with everything is to make a table. So it is annoying. I know it takes a long time. It's you can see we've done just 2 examples and we're almost out of time. So definitely, when you're doing these problems, leave yourself a lot of time to do them, just because they can take a while. And for the homeworks, if you want to use spreadsheets, if you want to use Google Sheets, Excels, definitely I'm all for that stuff. But just know that when come the exam times, you should be able to know how to do these by hand as well. So yeah, and I will tell you with certainty that on midterm 2 there will be a tax problem. Okay. All right, any questions on this? Okay. All right, so I have one more example for you. We may not finish it today because I want to give a little bit of time for you to pick up your exams, but I at least wanted to start it so we can kind of hit the ground running on Thursday. Okay. And so the idea behind this example is that we've looked at all 4 depreciation schemes kind of in a vacuum, right? In reality, you may have to combine different depreciation schemes together, because oftentimes, you're going to just take whatever the government gives you. So, ultimately you want to choose the depreciation scheme that kind of leads to the most money or the most economically favorable situation for your company, right? The same thing as everything. So in this example here, we're going to choose a combination So we're going to choose a combination of depreciation schemes, and we're going to see how the different schemes interact. Okay. But something like this is probably closest to what you're going to see in reality. So it's very rare to use just one depreciation scheme, because a lot of times that doesn't maximize the amount of gain that you can get. Okay. And so we're going to see how you can combine different methods here. Okay. All right. So we're going to get away from the trucks. So we're done with trucks. We're not buying another truck here. Okay. So we're going to say that we are part of a analysis firm, and our company has just bought a new computer lab. Or should they just purchased the computers for the computer lab. Okay. And these computers are going to be primarily used for research. Okay. Research and design, we'll say. Okay. Okay, so the initial cost of these computers was $150,000. Okay. And in terms of revenue, they're expected to generate $50,000 of revenue per year. These computers are going to require maintenance, and so you're going to have to pay someone and pay for parts each year. And it's expected that the maintenance is going to cost $10,000 per year on average. All right. All right, and so we want to compute the after-tax EUAW for these machines. To do that, we need some more information, or we need some more assumptions. Okay. Okay. So in terms of the tax rules, we're going to assume a 40% bonus depreciation. So 40% of the cost of these computers, we're just going to depreciate it right away. Okay. The remaining book value, so the rest of the 60% that we don't depreciate, we're going to depreciate using an MACRS scheme. And we're going to assume a 5-year property class. All right, so your company only plans on using the computers for 5 years. usually for these types of companies, there's some protocol, like every 5 years that there's a planned replacements for these things. That's very common in this world. Okay. Um, and at the end, it's estimated that you can sell the parts. You could sell it back to Micro Center or whatever for $25,000. Okay. And so if we assume an interest rate of 8%, and we're just going to assume the federal tax rate. So we're going to assume the federal tax rate of 21%. Okay. So given all this information here, I'll zoom out, you can see it all in one place. We want to compute the after-tax annual cash flow for this system. Okay. But I think we'll do that next time. So when we come back on Thursday, we'll start with this example. I think it'll be good to kind of see one more tax example on another day, just so you can kind of get an idea about it. And then after that, we'll jump right into replacement decisions. Okay. So there's a lot going on in this problem, and so we'll kind of tackle it from the beginning there. But for the rest of today, there's a couple minutes left. I want to get back to your exams. So remember, if you're here today, you can pick it up, and then Thursday I'll bring it back again. You can pick it up. Okay. All right. Any final questions before we wrap it up for today? Okay, all right, you guys can come up and pick up your exams. I try to separate it, but honestly, so one of my best buds is actually a tax accountant, and so there are scenes that bug him, but for me it doesn't really bug me. The ones that really bug me are the engineering ones that get that stuff wrong. I remember I was watching The Martian with Matt Damon back when I was in grad school, and I do like a lot of my research involves using high performance computing on like high performance computing clusters. And there's one part where Donald Glover kind of like is like typing on his laptop, and he plugs his laptop into a cluster, and then like 3 seconds later the computer is like, "Good job, your simulation is correct." And like that never fucking happens. The computer never says nice things to you. It never finishes your simulation in 3 seconds. It always takes days. There's always something wrong, and the computer's always mean to you. So that pisses me off more than tax stuff. So yeah, but my best bud is yeah, he gets annoyed with the taxes and interest stuff all the time. Yeah. It was entertaining. I still enjoyed it, but it's yeah. But at the same time, everyone knows that it's Hollywood and they got to do things a certain way because it's a show. So. All right, you too. Yep. I know